Welcome to today's video. I want to share with you Buffett's 5 rules to make more money and to outperform the market. So let's get straight into it. So, what's his first rule to investing? Buffett's first rule to investing is don't hold a stock for 10 minutes unless you're willing to hold it for 10 years.
That people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote. You don't need to pay attention to them.
The reason this rule is so important is because long-term holdings are the ones that compound, and this strategy fights off that gambling mindset to investing. It is important to give your investments time to grow because in time is where the magic happens. If you look at Berkshire's portfolio, which is the portfolio Warren Buffett manages, his biggest gains have come from his long-term holdings. Warren has held all these companies here for more than a decade. Take a look at Coca-Cola, for example. When Berkshire first bought Coke in 1988, they invested $1.3 billion. Now, if you fast forward 34 years later, that same Coke investment is now worth $25 billion, and in 2022, it paid Berkshire $704 million in dividend payments. So as you can see here, the key is to hold the companies for the long term. Now, Warren Buffett's second rule to investing is don't lose money. As simple as it sounds, yet many investors still break this rule.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth and you buy a group of them, you basically don't lose money.
In investing, a loss is only made once you sell at a loss. Until then, your losses are just on paper. So despite this rule sounding so obvious, it's one of those rules that really make you check your mindset. In stock market investing, you can pick 6 good businesses out of 10, but you need to make sure that your 4 bad investments don't ruin your good returns. Warren says that if you ever find yourself in a hole, you should stop digging. Most investors try to help themselves by doubling down on a bad investment to help their losses. However, it's better to cut off your losses and walk away. So if you actually do this, it significantly reduces your risk of loss. Now, let's move on to rule number 3, which is to always buy below intrinsic value.
For making an investment and laying out money now is to get more money later on, right? That's what investing is all about. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference after as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question of how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you?
This is what investing is about. It's about buying great companies at a good price. This is when you analyze the financial statement to see how much free cash flow the business is producing, and you value it based on how much you think it's worth paying for, and depending on what its future cash flows may be. This whole topic can be a whole nother video by itself, so if you'd like to see that, feel free to drop a comment down below. Now, this perfectly leads into rule number 4, which is to only buy businesses that you understand.
Old-fashioned belief that I should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know in general what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't isn't going to change the way people chew gum. It isn't going to change which gum they chew. You know, if you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. That evaluating that company is within what I call my circle of competence. I understand what they do. I understand the economics of it. I understand the competitive aspects of the business.
This is a fundamental problem investors face because when their stock begins to inevitably bounce up and down and around, investors won't know what to do. If you bought a business and it went down 20% the following week, did a good deal just get better? Or is there a fundamental change in the business's economics that may now affect its valuation? Investing is an easier game if you stay inside what Warren Buffett calls your circle of competence. This circle is a circle that contains businesses you understand. It doesn't matter how big the circle is. What matters is that you stay inside of it.
Defining your circle of competence is the most important aspect of investing. It's not how important, how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. And if I don't understand something, but I get all excited about it because my neighbors are talking about it, stocks are going up and everything, I start fooling around someplace else, eventually I'll get creamed, and I should.
The fifth and final rule from Warren Buffett is to be greedy when others are fearful and fearful when others are greedy.
Very peculiarly in terms of the reactions, because they're human beings, and they get excited when others get excited, they get greedy when others get greedy, they get fearful when others get fearful, and they'll continue to do so. And you will see things you won't believe in your lifetime and securities markets. I wrote an article for Forbes in 1979. I just said, how can this be? Pension funds in 1970 put 100 and some percent of their new money in stock because they were wild about stocks. Then they got a lot cheaper, and they put a record low in 9% of their net new money in 1978 when stocks were way cheaper. Investors behave in very human ways, which is they get very excited during bull markets, and when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say this is a lousy place to be. So they don't care what's going on in the underlying business, and it's astounding. But that makes for a huge opportunity.
If you look in the recent history of the stock market, the biggest returns have always been made when the market was most fearful. Take, for example, the dot-com crash back in 2002. Had you invested here when the market was the most fearful and people were selling out, you would have been up a handsome amount by the time in 2007. And let's say you invested in the global financial crisis right at the bottom of the market when people are thinking, oh, it's the end of the world, all banks are collapsing, everything's over. Had you bought in around this period of time, you would have been up a handsome amount not very long after. Or take, for example, the most recent crash, 2020, the COVID-19 pandemic, and when all that drama was happening. Had you stayed invested or even bought in at this point of the market, you would have been up so much by this time today. So when Warren is talking about being greedy when others are fearful, he's talking about investing in these points in time. When the market is selling off, people are scared, that's when you should invest. And when you should be fearful is always at these market highs, just like that, just before the crash. Now, obviously, when you're there, when you're in that moment, you might not always know it's a market high, but when valuations are stretched and a lot of companies are trading at a much higher multiple than they should be, that's when you should be fearful. When the overall market sentiment is high, everybody wants to jump into the market to make money, that's the time you should be fearful. Just to recap the rules we learned today. Number 1, don't hold a stock for 10 minutes unless you're willing to hold it for 10 years. The second rule, don't lose money. The third rule was to buy below intrinsic value. The fourth rule was to stay within your circle of competence. And the fifth and final rule was to be greedy when others are fearful and fearful when others are greedy. So that's all for today's video, guys. Subscribe to my channel to keep up to date with my videos. If you enjoyed today's content, leave a like and a comment below. And thank you for watching. I'll see you in the next one.